Hey guys, you're listening to the Tascha Labs podcast. And finally, we are getting some movement in the crypto market, right? So in the past couple of days, you can see both Ethereum and Bitcoin price have dropped about 10% or so. And you're seeing a little bit of rebound in the market right now. But the thing is, we've been oscillating in a very narrow range for a long time, as I talked about in the previous episodes. Depends on how you define this range, depends on how you define the border of the range, wider or narrower. You can say, okay, it's been a range for about 1 or 2 months, or even starting the March, starting the middle of March, you can say there hasn't been much of a movement in the market, right? So we just got this downside thrust in the market, and I want to talk about how we look at this, okay, today. But again, as always, my purpose here is not to give you any specific prediction or investment advice. My hope is through, looking through this, the price action and the market behavior, we can look at this together and help you to refine how you think about your investments and help you to refine your own investment framework. And define your own approaches. I think that's much more important compared to listening to any kind of specific prediction about how market will move next. Okay, so let's talk about this. So the first thing, if you look at I'm just looking at the daily frequency of price movement on Ethereum right now. The first thing you notice is that there was a large seller, especially in August 17th, Thursday, August 17th. I think this is probably the UTC time zone. Okay, so that may not be the exact time zone of your local time. But on my side, it's Thursday, okay? So what do I mean by large seller, and how do you know that's a large seller? So the way I think about this is the market price is ultimately determined by supply and demand, right? So when price is moving down, it's either there is increased selling, in other words, increased supply, or there is a reduced demand, in other words, reduced buying, or a combination of both. But usually there's a one-side dominant factor, right? But how do you know which one is which? Recall, again, there are multiple ways to think about this, but I'm an economist. I'm telling you about an economist way to think about this, okay? Recall your high school Econ 101 class, okay? You learn about supply and demand curve, right? You draw a diagram, and there is a supply curve that goes from the bottom left to the top right of the chart, and there is a demand curve that you draw from the top left to the bottom right of the chart. And the intersection of those two gives you the equilibrium market clearing price and volume of that market, right? So you can apply that framework to the financial market, and it applies perfectly. So that means when you see, and these demand and supply curve, they can move, right? So if these curve moves, it means there is some kind of structure change or regime change that is different from the previous equilibrium. In other words, there is some kind of shock that comes into the market, right? So when you observe a lower price but increased volume being sold and bought, being transacted, what it tells you is supply curve has moved to the right. In other words, there's increased supply, more selling pressure, right? On the other hand, if you see reduced price, but also reduced volume, what it tells you is the demand curve has moved to the left, meaning there's less buyer than before, or the buying demand is less than before, okay? And you can also vice versa. If you see increased price and increased quantity, increased volume, what it tells you is the demand curve has moved to the right. In other words, expanding demand, higher demand coming into the market, right? And when you see reduced volume but increased price, that means the supply curve has moved to the left, meaning at any given price, there is reduced supply. So in general, if you're positioned on the long side, if you're the buyer, if you're looking to buy, what you want to see is an increase in price is accompanied by an increase in quantity or increase in volume being transacted in the market, because that tells you the demand curve has moved to the right. In other words, there's a higher demand pressure in the market, and the price moving higher is not just entirely caused by less sellers. Because you want to see this because in general, that gives you, when there's fresh new demand coming into the market, that gives you a higher price momentum to the upside. It tends to imply a more of a lasting and more powerful price push to the upside. So that's what you want to see if you're positioned on the long side. And also, if you're positioned on the long side, and when you see price drop, you want to see a lower volume, right? Because that tells you the price drop is likely caused by what? By just lower demand than before. Maybe the buyers, they're taking a break, but at least it's not caused by what? At least it's not caused by increased selling, right? Because it's not caused by increase. In other words, it's not caused by supply curve moving to the right of the chart. That's not what you want to see, because that implies there is some kind of fundamental shift in the market that bring in more sellers, more selling pressures in the market. And that's not what you want to happen when you're positioned along in the market. So I hope this makes sense. To me, this is a very clear, very simple to use framework. If it's not immediately clear to you, I encourage you to take out a piece of paper, draw this chart on the piece of paper, and just move the two curves to the left and right and see for yourself, okay? But in this case, if you observe in the market in a couple days ago, like I said, in August 17th, what you see is you see a large price drop. But at the same time, you also see an increased market clearing volume. It's actually, I would say, I'm looking at Ethereum right now, okay, on the using the Coinbase data. It's almost like 2 to 3 times higher than the average trading volume of the past couple weeks or so, okay? So what it tells you is there has been a shift applying to the framework that we just talked about. There has been a rightward, the supply curve has shifted to the right, okay? So there has been increased selling pressure coming into the market. And that, at least that is the dominant factor. Now, why do I say there is a large seller? I don't know if there is just one large seller, okay? Maybe there are 2, maybe there are 3, but I don't think it's 100 or 200 large sellers. Why? Because if you read the news, there hasn't been any particularly negative news coming out of the market, right? For crypto. And in fact, I think by end of this week, was that Thursday or Friday? You saw there's actually positive news on the Ethereum side. There's Ethereum futures ETF being approved in the US, right? So that tells you this is not caused by some kind of industry-wide panic or distress selling across a wide range of investor base, okay? But you do see large selling. So what it tells me is there are probably, one or a couple or a few large seller in a short period of time that is moving this, moving the price forcefully downward, moving it out of the range that it has established over the past month or so, okay? So don't ask me who the seller is, okay? If that's what you're interested in, you can go foraging on Twitter or chat rooms. There are all sorts of conspiracy theories going on, all sorts of narratives, but that's not the kind of thing I'm interested in. I don't like to read gossips, except maybe it's gossips about Taylor Swift, okay? I just, for whatever reason, this is not type of thing that interests me. I don't tend to seek out for that type of information unless it just falls into my laps by itself, okay? But I cannot tell you who that seller is, but just looking at the price behavior, the price and volume behavior, I think there is at least one large seller for whatever reason. So what that reason could be, it's like it could be just like a similar story. I'm not saying it's an exact story, but a similar story that you've seen over the past year in terms of when this kind of dramatic selling event happens, right? Usually that large seller has it was in some kind of financial trouble that they had to liquidate their position for whatever reason. You also saw this back in March in the banking sector, right? Was that Silicon Valley Bank? No, that was not Silicon Valley Bank. That was a crypto bank. Was that Silver Lake, right? That's the bank's name. Keep in mind, there can be, I don't know exactly the financial story there is, but I will not be surprised that there's some kind of crypto entity, crypto firms, whether it's an individual large holder or it's a company that is under some kind of stress. Even you just look at the macro environment, right? The rate environment has increased so much, right? So even though if you look at the overall financial condition, it's not particularly tight, but objectively, the funding cost for companies has increased so much. Even for individuals, you look at the mortgage market, right? 2 years ago, you can get a long-term mortgage in the US with 3% interest rate. Now we are talking about 7% interest rate, right? So that's like more than doubled in less than 2 years. So it's the same on the corporate side. So that tightening environment is putting a lot of stress on certain companies' balance sheet, right? Especially if the company is leveraged. So it could be macro-related reasons that are causing some distress on certain individual entities' balance sheet that they had to sell their position in a short period of time. Again, I don't know what specific story is, but this is something I think you can more or less infer just by looking at the price action, right? But of course, once the selling start, because you keep in mind the market has been in this kind of lukewarm, doing nothing kind of ranging environment for several months now, pretty much, right? So it has established some sort of a range here. So, but once you push that price out of that range, it got people excited, right? So now and so it starts some sort of the domino effect or the flywheel effect. So you can think there are several sorts, right? One is there could be more shorts, right? More people start showing because if you have an asset that's been moving in the range for a very long time and suddenly got pushed out of the range, you tend to expect that trend to continue, right? In that direction where it's pushed. So it will attract more short sellers. And it doesn't have to be short sellers, even just buyers being with their stops taken out, right? Because it could be buyers if you're on the long side and you are in the market when the price is ranging. It's just very easy for you to have a very defined downside scenario, right? So your downside scenario would be when price moved out of this range. So it's very straightforward. If you're like a medium-term investor in Bitcoin and Ethereum, it's easy this is like a almost no-brainer in terms of where you will set your stop loss, right? Your stop loss will be just, probably maybe slightly below this range that you can see, which is very narrowly and well-defined by now, right? So as soon as if you have a bunch of, that means there could be a bunch of investors with their stop loss like concentrated right below the range that we have established over the past several months, right? That means once the price is pushed down outside of that range, you have a bunch of stop losses that got hit immediately, right? So that creates additional selling pressure in the market. So I call that the long squeeze, right? So you the funny thing is you usually hear people talk about the short squeeze, right? So when price moves up, it kind of it takes out the shorts. But the thing is, actually, there are way more frequent long squeeze to me than short squeeze in the market, because there are a lot more investors on the long side compared to the investors on the short side. Maybe depends on the asset, right? You could have like in terms of your average stock, maybe like less than 5% of those shares are being short. I'm talking about the average stock, okay, not a like widely shorted stock. So that means 95% of investors are positioned long. So if price move downward, you get like a lot more stop losses being hit compared to if the price moves upward, right? I think this is one of the reasons also why a lot of times you see the price move down much faster compared to when they move up. This is exactly this is one of the contributing mechanism, right? Because when price start moving down, like very quickly and very dramatically, it hits a lot of stop losses very quickly, because most people are positioned long. And if they are judicious and disciplined enough to put a stop loss on the position, that's when that forced selling will happen, right? So so the long squeeze happens every day in the market, and a short squeeze only happen once in a while. Or maybe that's why that's news, because if something happens every day, it's no longer news. Okay. So, but my point is there are multiple mechanisms that can contribute. Once you have a large seller initiating the selling, and then that will lead to a bunch of domino effects that push the price down even more in a relatively short period of time. So so now the next question is, so where do we go from here, right? So so you also of course, whenever this kind of thing happens, you will hear a lot of chanting, especially in the crypto circles, about buying the dip, right? Whenever price dips, there are always a bunch of buy the dip chanting. Okay, so whether that's something that is suitable for you, it really depends on your individual framework, right? So to me, the buy the dip it is the right strategy if you are one of two types of people in this particular case. Okay, I'm not talking about in all cases, just this particular case that we've seen in the past 2-3 days. I would say in one case is you are the insider. Okay, if you say, for example, you tell me, Tascha, I work for this company that was this large seller that you're talking about. And I know exactly how much we had to sell, and that selling now is done once and for all, and we are in a good position. We have no more trouble and no more selling to do. So I don't see any downside from now on. If you're the insider and that information is your edge, okay? So to you, now there is a higher probability to the upside than to the downside. And if that's you, then I would say, yeah, go ahead and buy the dip, right? That's the first scenario. The second scenario is if you are a professional short-term trader, okay? If you're a professional short-term trader and you tell me, Tascha, I've seen this movie 100 times. I have studied the past 50 similar incidences of dramatic sell-offs in Bitcoin and Ethereum. And I know exactly the 5 scenarios that's potentially going to play out from here. Okay. And I have a very defined strategy of how I'm going to take advantage of the opportunity that goes as follows. For example, I will watch for a steep sell-off. That's the first step. And the steep sell-off to me is defined as, for instance, price moving downward by at least 2 times the average price range of the asset within 10 minutes. That's my very precise definition, or your very precise definition of what a sell-off means. And the average price range for Ethereum is about right now $60, $70. No, yeah, $60, $70. That's average price movement in an average day. For Bitcoin, it's probably $800 to $1,000. So if you tell me, if I observe the sell-off as I defined clearly, I will start looking for a bounce. And how I define a bounce is price increase by at least half of the daily price movement range of the asset within 10 minutes. And if I see that, I will start going long. And after I go long, here is my stop loss set according to such and such rule. And my target profit-taking price target is set as such and such. And once price moves up by half of a daily price range, I will start taking profit. And once price moves by at least one daily price range, I will take 80% of my profit. And once price hits the, I don't know, the volume weighted average price, I will be completely out of my position. And if I'm not in profit in 20 minutes after I started buying, then I'm completely out of the market, out of the position, even if my stop loss is not hit. If that's you, if you can tell me, if you can give me such a detailed strategy plan that covers 5, 6 possible scenarios, in other words, you are very specific, very professional about this, because we're talking about in this type of scenarios, you have very fast market movement, right? So you got to have that detailed plan. You cannot just get in a position and start thinking what you're going to do. You don't have the time for that. So, but my point is, if that's you, if you have a detailed strategy that is based on past analysis of past incidences, okay? So it's not just something that you imagined out of thin air, right? If you have that, then by all means, this is like your golden opportunity, right? So, but if you are neither of those, if you are neither an insider which has special information about who's selling and whether that entity or person has done selling, or you are not a professional that has analyzed this kind of scenario and knows exactly what your plan is. If you are neither of those, then I will say you got to think about what's your reward risk in buying the dip in this kind of scenario. I think, to me, one of the biggest risks in this type of incidents is if, as we have hypothesized, okay, if there is indeed a large seller who are selling because there was some kind of trouble that make them have to liquidate some of their position. If that's the case, the biggest risk is, do you know if they're done selling or not? I don't know, okay? I don't have that special knowledge. Maybe you do. If you do, then go ahead, be my guest. Buy the freaking dip, okay? But to me, that is a very tangible risk. If my conclusion is to say there is a large seller who was there on Thursday. Now, I see some price rebound, yes, but how do I know that seller is not coming back on Monday? Okay. If that seller is like selling because of they're experiencing some financial difficulty or any kind of other difficulties, like troubled entities, they don't solve their trouble in a few days, right? So What if they had to do more selling? So in other words, how do I define the downside scenario? In this case, I have no way to define that. Now, you may argue, if you're one of those people who are really into technical analysis, and you can say, okay, but Tascha, look, we have established a bottom, like a local bottom here, because we've hit some kind of local support. If you look at the price behavior in the past, yeah, this is like bottom of the range. If you look at how much the price dropped in June, for example, in the middle of June, we also had a pretty sharp drop, and then the price was supported at around this area. So I expect we have hit the local bottom. So this is time to start buying. In other words, if you're playing this type of some type of support resistance game here, I mean, fair enough if that's your framework. Okay, to me, it's particular in this type of like a kind of dramatic forced selling scenario. I don't want to trust any kind of support resistance level. Okay, to me, do support resistance levels work? Sometimes, and they especially they work very well in particular market. In what kind of market? In the market that that doesn't have a lot of external shocks. In a market that's always the same bunch of players. There's no new players. And there's no like external news or catalyst or good or bad. Basically a market that is in extreme stability. And then it tends to respect the so-called support and resistance, right? However, if it's a market that has frequent structural changes or external shocks, like, forced selling, you cannot foresee, right? Then I don't really know how trustworthy, how reliable the support resistance levels are. Okay, I give you an analogy. In the US, we all drive on the right side of the road. In the UK, you drive on the left side of the road. Okay, so that's a social convention. Everybody respect the rule. It's like if you have the same bunch of players, they respect the support resistance level. Everybody can see in the market. But imagine you suddenly drop like 50 million Americans into UK. Okay, and all those people are extremely bad at driving at left side of the road. You can have a lot of chaos. Okay, you have much less respect to the driving convention or whatever. Okay, so what I'm telling you, the analogy to the market is if you have, for example, a new segment of investors coming into the market, then your existing so-called support resistance will tend to work less well. Or if you have sellers who have new situations coming in, other reasons, external reasons that will make them have to sell, then your support resistance, I don't know how much those are worth. Okay, so in a bigger picture, you can say if the price has a strong uptrend or a strong downtrend, by definition, all your previous support are taken out in the case of downtrend, and all your prior resistance are taken out effortlessly in the case of uptrend, right? So if support resistance work, then you will always have a ranging market. You will not have a bull or bear market at all. So that's something you need to think about, right? Is this the kind of scenario where price will have a large likelihood to respect whatever support you established before? Okay. This similar thing applied to any kind of technical indicators you use, like overbought, oversold. It's the same deal. Okay, same deal to me. So, but again, this is how I look at this. Is like as the average investor who do not have the insider information. If I just look at this like in terms of price action, I do not see for me a clear edge here in terms of what I get out of buying the dip. Okay, so but then that's me. That's the way. That's how I approach the market. How you approach your framework may be totally different, right? So, and also when I look at so in general, I don't like to buy weakness. I like to buy strength. Why do I like to buy strength? Because if I buy strength, by buying strength, I mean I want to see something that has clearly established kind of a baseline price level and is on a uptrend with some kind of confirmation. I'm not going to go into details of what kind of confirmation I'm looking for, but at least I'm telling you, I want to see price is on a uptrend already. Now, you may argue, well, then you are missing out the best price, right? Because you are paying the higher price, and I'm fine with that because that allows me to define my risk more clearly. So, but for you, you may be different, right? Depends on your own framework. And this is kind of thing, you know, it's really, it's less than helpful, or it's extremely unhelpful if you listen to what other people say. It's if you listen to people who tell you, oh, we're gonna rally from here, it's gonna leave the all the people on the sideline and so on and so forth. Whether that's right or wrong, however it turns out, I don't think that's helpful for you, because that's, to me, that's not helpful at all, because that's completely irrelevant to my own framework, right? So if you want to be consistent in the market, you want to be you want to follow your own framework and your own thinking, right? And that type of outside narrative or other people's narrative, other people's price predictions, it just, I would say, even it's a little bit toxic to as a investor who's trying to make your own independent decisions. And to me, and also so why do I think so to me, this type of scenario is definitely not a buy here. It's definitely a no. Okay. Why is it a no for me? Because again, I cannot clearly define what is a downside scenario. Okay. I don't know how much whether there is this seller is down selling, how much trouble they're in, whether we will have further negative shock, especially given right now the sentiment of risk asset is not exactly great. And I think I covered a little bit of that in the last episode. If you look at the equity market, we are in some sort of correction, to put it mildly, right? But the market sentiment is not going up right now, to say the least. So in this kind of scenario, this is definitely a no for me, because I cannot clearly define where I need to set my stop loss, basically. Compared to a scenario where, and this is the reason why to me, I like to buy strength. And I would rather to see like something that I has clearly broken out to the upside, and I know exactly where to set my stop loss, because my stop loss will be wherever the price level that the thing is breaking out from. And if the price goes back down and breaches that base level, then I know I'm wrong. The thing is not on a uptrend. But that is very clearly, I can very clearly define that, right? And in this type of thing, you know, it's already dropped very fast in a couple of days. And yes, it's showing some rebound. Yes, it seems there is a support level, but do I know if there is a second shoe? I do not know. So how do I define my downside? To me, it's very hard to define. So actually, this is something important I want to talk about. To me, defining your downside is like the most, if not the most important thing in your investing framework. It's one of the most important things. And the reason is, it's one of the things that you have the best control of. So if you think about in a investment, any investment decision, you have a expected value, right? You have a expected value of a certain investment position that you are taking on. And the expected value is equal to what? Is equal to the probability that you're going to make money, in other words, your win rate, times the average expected gain from this investment, minus your loss rate, which is 1 minus your win rate, times the average expected loss of this investment you're making, right? So out of these, so these are the parameters that define your expected value. And you always want your expected value to be greater than 0. Otherwise, there's no point taking this decision, taking on this position. Huh? So, but if you think about outside of these 4 components, well, 3 components actually, because your loss rate is just one minus your win rate. So 3 components define your outcome: the win rate, the magnitude of win, and the magnitude of loss. Out of these 3, which one do you think you have the most control of? I will argue the magnitude of loss is the one you have the most control of. Why? Because your win rate, what's the probability that you're going to make money on this, is influenced by other factors not within your control. It's influenced by market conditions, as we talked about last time. It's influenced. There is a degree of randomness in that. Sometimes you get lucky, sometimes you're extremely unlucky, right? So there is a high degree of there's a high degree of magnitude that you cannot control in your win rate. Of course, it also depends on your skill. So that's the part you can control, which is your judgment and your skill. But the thing is, there is some randomness in it. And also the magnitude of your win. This is also something that it's not within your, it's even less within your control, because you can, of course, you can make a judgment in terms of, okay, I expect this thing will go up by X percentage. But really, there is a high degree of randomness in that, right? So this is also something you don't have a firm handle on. What is something you can have a control of, though, is the magnitude of loss, because you can define a stop loss, right? The stop loss being your entry price, the difference between your entry price and your stop price if you're positioned long. In general, I'm here talking about when you're positioned long, right? If you're positioned short, it's the opposite, but that's less people do that and less frequently, right? So it's the magnitude of a stop loss. This is something that you can control by deciding when to enter and what price you set as your stop price, right? So you say the old saying says, if you want a happy life, you want to let go of things you cannot control and control the things you can control, right? It's the same thing with investing. But the thing is, people don't pay attention to this, okay? There is a second, people usually pay attention to the part that says, let go of the things you cannot control, which is great wisdom. But they don't pay attention to the second part, which is you've got to control the things you are capable of controlling, right? Otherwise, you're leaving the alpha on the table. So in this case, the part that you can control is the stop loss, the magnitude of the stop loss. Okay? And you want this part to be as small as possible in order to achieve the positive EV, positive expected value, right? So, but the funny thing is, in a lot of cases, people tend to have the opposite instinct, okay? So, because if you follow the logic that I've described so far, you will realize that if you have a higher win rate, that will actually give you more leeway and more room to have a higher stop loss to still get a positive expected value, versus if you have a low win rate. If you have a very low win rate, that you definitely want a smaller stop loss to control your less, if your loss rate is 60% compared to if your loss rate is 30%. In the first scenario, you want to smaller stop loss. Okay, that is the I would say one of the fastest way to improve your investment performance if you have a low win rate. Right? But people in general, in reality, people instinctively, they tend to do the opposite. Okay? When people have a smaller win rate, their instinct is to give it more room, meaning they set a wider stop loss. That's like exactly the opposite you want to do. Okay, if you have a lower win rate, you you are better off setting a small as possible stop loss. And what is your ideal stop loss? It's 0. I know it sounds extreme, but seriously, if you think about it, this is the portion, your loss, probability of loss, your loss rate times your magnitude of stop loss. This is the part that you need to subtract from your expected value equation. Okay, it's contributing negatively to your expected value. So you want this part to be as small as possible, and ideally the smallest value you can have for this part is 0. Okay, so ideally, theoretically, in the perfect world, your stop loss will be 0. This is, I know this sounds extreme, but if you but seriously, this is what best investors do. If you read, like, for example, the Market Wizards book, which is very entertaining to read, about like this guy interviewing like the top traders and investors, what do they often tell you? Like, people tell you, my best trades are those that when I'm immediately in profit after I take this position. Why? Because if you are immediately in profit, you can very quickly move your stop loss to 0. That's like perfect scenario. That's the perfect world. Okay? Anything that deviates from that is a second best. Now, I know maybe some of you are thinking, but Tascha, if I widen my stop loss, it helps me to increase my win rate also, right? Because you give it more room, so it has more chance to, if you're in a loss, it has more chance to recover, and so on and so forth. Yes, there is sometimes that kind of effect, but notice though, that is a second order effect, okay? So the magnitude of your stop loss, its impact on your expected value, that is the first order immediate impact. For your stop loss level to affect your win rate, and your win rate to affect your expected value, that is a second order effect. Will that cancel out, make up more than the effect, the first order effect of your stop loss on your expected value? That's something that you gotta think about, okay? If you're not clear, please, I encourage you to write it out on a piece of paper and you stare at that equation for like 15 minutes and think about this clearly. So to me, the fastest way, ideal stop loss is 0. And the fastest way, if you are in a drawdown and you want to improve your, performance, of course, you need to improve your judgment and skill, but really the fastest way is to reduce your stop loss. and this is counterintuitive to a lot of people. So why am I talking about this? Oh, I digressed, I noticed. So again, Tascha, you again digressed. The reason I'm talking about this is because I was talking about whether like current scenario is the type of a price action that we're seeing on Bitcoin and Ethereum or crypto in general. Is this the type of scenario I will consider buying? To me, this is a no, and the reason is because I have no idea how to define my stop loss in this case. Okay. Unless I'm doing intraday, like a really short term, and I see a bounce, okay, maybe this bounce will last for, I don't know, a few hours, a few days, but I previously talked about, I don't do intraday, very, very short-term trading in crypto. And the reason I talked about in my previous episode, if you check, like, I think it's maybe a couple episodes before, okay? But if I'm in this, like, take a position in like a Bitcoin, Ethereum, any kind of tokens, I want to stay for, at least a week or so, a week or two, right? Do I know how to define a stop loss if I want in this right now at this moment for that type of position? I don't know, right? That's beyond me. Maybe you have a better idea, but not to me. Okay. So again, not investment advice. There are all sorts of ways to make money. This is just how I look at it. I'm not suggesting you buy or not buy, but I hope this helps you to think about your own approach, gives you some inspirations to look at things maybe a little bit differently, and eventually you got to come up with your own way to make money, right? Okay, so that's all for today. And next time, I got some interesting question about my last episode after I published this episode about how to get in sync with market cycles, right? So after I published that, I got some interesting questions. So I think next time I'm gonna do a Q&A to answer some of those questions. And if you have questions, by the way, about the market cycles, please do provide, write your comment, write your question in the comment, or you can DM me on Twitter or send me an email. I think you can also post comment if you're listening on Spotify now. They just started a comment section under their podcast UI. Okay. So that's probably what I'm going to do for the next episode. And also, as I told you last time, I'm trying to make more content right now because it's summer and things are a little bit slower and I have more free time. So I'm going to be definitely a lot busier starting maybe the second week of September for all the way till November. So I'll probably be missing action for extended period of time starting then. But before that, I'll try to make some more episodes. Okay. So if you have any ideas something that you want me to talk about, feel free to comment or let me know. Okay. And also, if you're listening to this on Spotify or on Apple Podcast, don't forget to leave a rating or a review. And if you're listening on YouTube, give this episode a like or comment, and definitely subscribe to the channel. Okay. So that's all for today. I will talk to you next time.